Hey there, everyone. Happy Tuesday, March 4th, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you not from a chilly Redmond, Washington, but an obvious hotel room in New York City, in New York this week, then heading down to Baltimore before heading home to Seattle over the weekend. But I appreciate you hanging with me. Could not get a show in yesterday. The travel didn't quite work out. Plane was delayed. Didn't get to the hotels until super late. It just wasn't meant to be. The market sold off aggressively, of course, on a travel day. Today, it looked like 5850 would actually be breached back to the upside, but by the end of the day, was not to be. Right, the S&P rotating lower in the last 30 minutes or so of trading, retesting essentially the lows for the day. So I would argue you could probably consider today a follow-through day after yesterday's push below the 5850 level. By my read, that line in the sand has now been broken. And if a day like today does anything, it serves to reinforce the fact that we are now below that key level of now resistance. So with that in mind, we're going to look at all the different market conditions. I do already see some questions coming in. We'll get to as many as we can for sure, because I know a lot of questions are coming up in an environment like this. So we'll get to as many as we can. And then we'll wrap for the evening. Getting to the market recap and focusing on how things have played out today, we can see, again, about an hour ago, I'm preparing for the show, and it looked like we were actually going to get a day in the green. It looked like a bit of a recovery day, with the NASDAQ actually leading the way higher and technology actually printing a positive day. But again, by the close, all of that unwinding yet again. The S&P down another 1.2%. That's after Monday's sell-off. So that brings us down to 5778 and change for the S&P 500. The NASDAQ outperforming, down about 1/3%, finishing around 18,285, and the Dow leading the way lower, down about 1.6%. As you'll see when we get further on in the episode today, financials actually the worst sector today. Which is interesting because that's where we've seen some strong outperformance year to date. Financials have been one of the better sectors, along with healthcare and some others. But today, not the case. Mid caps, small caps, all down about a 1.5% for the S&P 400 mid cap and the small cap index as well. The VIX pushing higher. The VIX finished yesterday well above 20. Today, continuing to push that to the upside. We're currently around 2350. There have been so many changes here in the last week, after so many changes in the last month, after so many changes in the last couple months. And we've been tracking those incremental changes day in, day out on the show here, but certainly reaching a fever pitch of that rotation to more defensive movements today. One of those, what has really changed here in the last week, right? What's new and different? Couple things come to mind immediately, and we'll probably add more as we go through the show. Number one, the S&P finally breaking that 5850 level. And we've talked about that as a line in the sand. With all the choppiness above 5850, you could write that off as noise. Below 5850, that's a bearish rotation by my read. And we've certainly gotten that this week. The VIX pushing above 20. Now, we've had times where the VIX has gone above 20. It hasn't been the end of the world. I would argue this is one of those times where it really is speaking to elevated volatility and more of a panic feel to the markets this week. The third thing, which is still kind of too early to decide, would be our market trend model. We put a lot of weight on our market trend model, particularly the medium-term time frame. That's served me very well at helping me navigate short-term pullbacks within long-term uptrends. That's when the medium-term model remains bullish and the short-term model turns negative, as we covered on Thursday, Friday show, I want to say last week, in a little more detail. This week, it looks like the medium-term model will blow below the zero level for the medium-term time frame on the S&P. It's already went negative last week for the mid-cap and small-cap indexes, but has not for the S&P. It looks like that would happen again, barring some huge recovery through the remainder of this week, which is certainly positive. But looks like the medium-term model is going to go below the zero line as well. And what that means, what that tells me, is just no longer, you really can't label it a short-term pullback within a long-term uptrend. All of a sudden, it starts to be more of a cyclical downtrend within a secular bull market. We have to go up a time frame to address the deterioration that we've seen. We'll go through a couple of those charts, including the S&P, the VIX, and others here as we get to the chart review portion of the day. Bonds moving lower, and that's actually an interesting development because up until today, what we've seen here in the last couple of weeks has been bonds breaking higher, right? TLT's been breaking out above trendline resistance, 10-year yield breaking down through trendline support. So as stocks have gone down, bonds have actually been going up. Not today. Bonds actually sold off through the course of the day today. So while stocks kind of sold off, rallied, and then ended up lower, bonds are pretty much down for the entirety of the day. The TLT finished down about 1.25%. Interest rates generally moving a little bit higher after yesterday's drop and today's rally. The 5-year point was just below below 4% yesterday at the close. Today, kind of getting right back to up to that 4% level. The 10-year yield is currently around 4.2%, and the long bond yield just about 4.5%. So, generally though, we've been seeing a rotation away from stocks into bonds. We have a chart showing that ratio with the two of those, which has been pretty telling here. Dollar index moving slightly lower, so no real strong dollar environment here. The UUP was down almost 1% today, and did our monthly chart review for my market misbehavior premium members earlier today. One of the things we talked about was the dollar chart, because what's happened is if you look year to date at performance EFA, which is global developed stocks like developed Europe, like Germany, UK, Switzerland, developed Asia like Japan and others, it's up year to date, a decent amount, while the S&P and the NASDAQ are down. All right, looking at the commodity space, a little bit of a mixed bag, although gold and silver continuing to push higher. This is one of those times where gold and silver very much feel like the safe haven that they tend to have the people tend to think of gold as a safe haven. We tend to get that label, but it's not really been the case at times, right? Gold actually did quite well in 2024, as stocks, of course, did quite well. But year to date in 2025, gold continuing to test new all-time highs, while the S&P and the NASDAQ are pulling back aggressively from theirs earlier this year. So gold and silver continuing an upward climb. The GLD up about 0.9%, almost the identical move on a percentage basis for silver. The energy side, a little bit more mixed, but energy stocks actually did okay today, relatively speaking. Bitcoin and other cryptocurrencies, it's been a volatile life for Bitcoin, but especially here in the last couple of weeks and definitely in the last week. Within the last couple days, right, we've talked about and we've learned about the U.S. government. Trump announced a strategic cryptocurrency reserve, including Bitcoin, Ethereum, and a number of other things that he mentioned. That caused a brief spike in Bitcoin before it rotated lower through the course of the day today, drifting lower. Bitcoin got down to as much as 82,000 earlier today. During the equity trading session, it did get up to almost 89,000, currently trading just below 88,000. So it did sort of rotate lower as equity sold off going into the close. Cryptocurrencies have essentially been a leveraged play on other risk assets. It's really just speculation. And you can see generally Bitcoin following the trajectory of the equity market, selling off yesterday, rotating higher today during the equity session, but rotating lower into the close. I'd say the chart of Bitcoin, very, very challenged. We did grab that to look at it in a little more detail. We'll talk about moving average support and maybe finding its footing here. But for now, still a bit of a question mark. All right, the 11 S&P sectors, technology for much of the day was in the green, but that sell-off going into the close did bring tech below the zero level. So the XLK was the top performing sector, down 0.1%, essentially flat. Communication services, number 2, down 0.8%. Healthcare, number 3, and energy, both down just slightly below 1%. Financials, the big disaster today, down 3.5%. We grabbed the chart, I think, of JP Morgan. I don't know if I grabbed any other financial stocks here. I had to stop grabbing individual stocks because there's so many that are doing so many things. So I tried to just handpick, select a number that I thought would be good to illustrate different phenomena. But certainly there's plenty of individual names testing some key levels and experiencing some serious rotations here right about now. But the financial sector giving back a lot of those gains that they've experienced so far in 2025. Industrials, second from the bottom, down about 2%. Consumer discretionary and consumer staples both down about 1.7% today. Breadth was not good. That is my official medical opinion on the breadth conditions here. Noticeably the NASDAQ composite better, but still bad, right? About 59% up, 59% down, declining. about 38% advancing in the NASDAQ composite. Compare that to the S&P with 83% down, only 17% up. So this wasn't a 90% down day, which is one of those kind of, what's the word? Kind of trading maxims, one of those things you'd often look for. And there's been some interesting work that I've seen a number of people do on 90% up days and 90% down days and what they kind of represent. Today, more of an 80% down day, but still quite a bit of distribution. That means 4 out of 5 4 out of every 5 S&P 500 stocks finished in the red today. Here's that market trend model, and I feel like through the course of 2025 so far, we went from everything in the green on all time frames to the short-term model flipping negative coming here recently. The medium-term model pivoting bearish on mid caps and small caps as of last Friday. And again, I don't formally update my market trend model until Friday at the close. It's a weekly exercise that I do after Friday's close every week. But if this was the end of the week, if today was Friday and we were locking it in, the medium-term model would turn negative. And it's been bullish since late 2023. I think November of 23 is when the medium-term model on the S&P turned bullish. It's been bullish since then, all through 2024, all through early 2025 until right now. So we'll see if the week ends in a similar position, but that for me would be a big red flag for risk assets. My medium-term trend model, it's kind of the main one that I use to think about whether I want to focus more on capital growth and finding uptrends or capital preservation and unwinding positions, raising cash, waiting for that lower price action that would give us a better entry point to ride the next leg higher, which will most likely come at some point. Looking at the Magnificent Seven and Friends, given the distribution today, kind of mixed in a surprising way, I would say. Alphabet up 2.3%. That's your best performer. Nvidia, which we did grab to review here in the chart review portion, not a bad day, up 1.7%. Microsoft and Netflix basically flat for the day. On the downside, Tesla continuing to deteriorate. I feel like I'm no longer quoting news on Tesla. It's just sort of continuing to add on. I think it was downgraded by a lower price target from Bank of America or one of the banks. So down another 4.4%. Meta down 2.3%. Apple down less than 1%, but enough. All right, let us get to the market carpet. And if you enjoy the color red, you will appreciate the particular contours that we're going to focus on today. As a reminder, I can't see the questions coming in. Got a bit of a conversation happening in the chat, and I'm 100% fine with that for sure. You can put comments anywhere you're watching the live stream here. If you're tuning in live on Facebook, LinkedIn, YouTube, and X, I appreciate you so much dropping questions in. At the end of the episode, I'll try to take a question or two before we wrap for the evening. Anything we don't get to, we'll put it in the final the chart this mailbag, we'll call it. We'll be doing an all mailbag episode on Friday, and we'd love to answer one of your questions live on the air. All right, looking at the market carpet, we can see, again, bright red in a lot of the different sectors. Noticing that technology nowhere near as negative as everything else, and that's a bit of a different look. Tech has been one of the worst places year-to-date 2025 in terms of general distribution, in terms of relative performance. But today, despite some Oracle, Intel kind of names going down, the average stock actually did okay, and that's why tech was the best sector today. Within communication services, you have Alphabet as kind of a positive outlier with some others as well. Note the bright red in financials. This was a rough day overall for the financial sector, and some of the leading names from Berkshire to the payment processors like Visa and MasterCard. Bank of America breaking to a new swing low. Some of these are still okay. I mean, I don't think you can look at the chart of Visa and say that that there are concerns from a technical perspective just yet. We're still making higher highs and higher lows, made a new all-time high over the last couple of days. So, the trend is still fine. Charts like JP Morgan, charts like Bank of America, a little less fine. BAC comes to mind as one that hit resistance and now has made basically a big double top pattern and now has broken through the low from December on a closing basis. That's a bit of a concern. We can see a lot of financials have demonstrated a bit of a bearish divergence going into this year. I'm going off script and just grabbing Morgan Stanley. I almost called this Microsoft. Morgan Stanley, ticker MS, is an example of a divergence that you'll see in a lot of financial stocks here. JP Morgan not, and Visa and MasterCard not, but a lot of the banks you'll kind of see this pattern: higher highs November into early 2025, lower momentum, classic bearish momentum divergences. And this is what we talked about, a couple of weeks ago. We talked about these charts that are still going up on weaker momentum. And unfortunately, that's usually a sign of bullish exhaustion. That usually tells us we're toward the end of that uptrend phase. And then the question is, what comes after? And do you get that downside validation? Morgan Stanley breaking below the 50-day moving average, now trading right to that December low. So, we're still making higher highs and higher lows, but this recent pullback is right at that point where you all of a sudden have to not call it a brief pullback and start to call it something more significant. I think we're right at that point around 120 where Morgan Stanley's sort of is it going to work or is it not kind of chart. And again, I'm seeing a lot of those in the financial sector pulling back and kind of testing those swing lows from earlier. What else on the heat map? And I would say generally, one of the differences you see today is the story here over the last week or two, as we've really started to accelerate here in the last week. What we've seen a lot here recently are the growth sectors going down. So you see red in technology, consumer discretionary, communication services, but then you'd see green in financials, in defensive sectors, right? Like real estate, utilities. Randomly, things like healthcare or industrials look better. So there was that time where it was like growth down, value up, and it sort of felt like it wasn't a rotation out of equities; it's a rotation to other equities. This feels more like a risk off kind of move so far this week, as you're seeing a lot of red across the board, and it's not certain sectors are up and we're still okay. A day like this feels more like an everything down kind of day. And again, with some exceptions of things that are doing okay. And I would say technology in particular is impressive right about here, but certainly something to watch. Before we get any further, I just want to let you know I'm going to be speaking at the Money Show Virtual Expo next Wednesday, March 12th, 2:50 p.m. to 3:20 p.m. Eastern. I've got 30 minutes to share with you. We're going to have a lot of fun. Those of you, I think some of you attended the Las Vegas Money Show because you said hello. But I'm going to do a scaled down version of that presentation called the 4 Deadly Sins for Investors. Something I think every investor needs to work on, but we'll talk about the timing of entry and exits, some of the behavioral reasons why we tend to buy too early, buy too late, etc., and some of the technical tools we can use to address each of those different 4 deadly sins that I found we fall victim to. You can get to this page and sign up for the event. It's free. You go to marketmisbehavior.com/money show. It will take you to this sign up page and just click on register now at the bottom, or I think enter your information in the upper right corner. That's how you can sign up for that event. And again, I'm one 30-minute presentation among a number that are going on over a couple days, but hope you can tune in there, and we'll hope to see you in the virtual expo. All right, we finish off doing the chart review portion of the day. The S&P 500 daily chart, we are now testing the 200-day moving average. Earlier today, about an hour and a half ago, I'm preparing for the show. I'm looking at the charts and I'm seeing, S&P 500 trading down to the 200-day, but trading right back up to 58.50. Is this a big hammer candle kind of thing, showing some accumulation off of that key support level? Did not finish that way. And with the week close, it really looks more like a follow-through day, right? So, if you look at Friday's session, we opened around 58.50, traded below it, but closed higher. Monday, we opened higher and closed right down at 58.50, almost to the button. Today, we're actually pushing below there. So I think 58.50 is broken at this point. We regain it through the course of this week. That's great. I think it gets us back to this range bound scenario. And I think you consider this breakdown very similar to the January breakdown, but we grow below the 200-day moving average, which is where we traded to today. I think that unlocks potential further downside targets. I'm currently eyeing around 5,400, 5,500 for a potential downside target. It's based on a couple things: Fibonacci analysis based on the range of this basing pattern that we experienced here in the last 3 months. I just did a video for Stock Charts TV a couple hours ago. If you go to the Stock Charts TV YouTube channel, check out my latest video where I talk in a little more detail about some of those downside objectives, how they're calculated, and really just thinking about how to navigate a downdraft. But as I'm looking at the chart of the S&P 500, again, we've been talking about the rotational element, the leadership changes, the structural changes, the divergences. Now I think we're getting to that next stage, which is more of the actual breakdown, more about defining the line in the sand and seeing if they go below that. I think every day we stay below 5850 is a problem. I think holding the 200-day is vital. If we're not unable to do that, I think that unlocks much further downside potential for the S&P. What's funny is you go down to 5,400, 5,500. That's only a 10, 11, 12% ish drop is what the math says in my head as I'm doing it. I should not do that mental math as I'm trying to do a live stream. It sounds about right, but I can actually hold on. I can actually use the power of the stock charts platform. Here we go. So there's the 6150 high. We're currently, we closed, we're down about 6% off of the highs, the 200-day a little bit further, about 7%. If we go down to like 5,500, that's only a 10.5% drop. 5,400 would be about a 12% drop off of all-time high. So, if you go through market history, 10 to 12% off of an all-time high is not an unreasonable move, even within a cyclical uptrend, right? You can still call that a long-term uptrend, and certainly in a secular bull market. What's actually unusual is how rare we've had that pullbacks to that degree so far. It's not that we would have one. The fact that we haven't had one is the real unusual feature of the last 18 months, and if not further for stock, just the lack of significant drawdowns, which are actually quite common in bull market phases. All right, we'll talk about the breadth conditions. We've covered how the breadth has deteriorated over the last couple months. Let's talk about what's happening this week. With today's drop, following yesterday's drop, the percent of stocks above their 200-day moving average dangerously close to getting below 50%. Now, the narrative I've been sharing with you on this chart is, all right, we're testing 50% of stocks above their 50-day. If we go below that, that's a problem, which we are today. We're down to around 42%. But the reason why I'm not kind of longer term bearish is the fact that the percent of stocks above their 200-day is still well above 50%. It's been around 60% here for the last 6 weeks. So the S&P has been well above its own 200-day moving average. Most stocks in the S&P have been well above their 200-day as well. That is all starting to change just in the last couple sessions. And I would say if the S&P breaks below its 200-day, if this indicator gets below 50% and most stocks in the S&P are below their 200-day, that is definitely not bullish. And what it does is it tells me that we're at least probably going to experience a sort of late 23 kind of deterioration, which ended up being about a 3-month pullback before a resumption of the uptrend. Or it's a 2022 kind of drawdown where it's a much longer, more protracted decline. It's about a 10-month drop from end of December of 21 to the eventual low in October of 23. So again, holding these key levels is vital, and I would say we're at that point where breadth indicators like this, the long-term breadth, which has been okay for so long, all of a sudden looks a lot less than okay. I mean, I threw this in here just to celebrate the fact that the Hindenburg omen did actually meet all 3 requirements today by my reading, and that's actually on yesterday's session. To be clear, that's not updated for today's session just yet. Yesterday, we had at least 2.5% of NYSE listings making a new 52-week high, and at least 2.5% making a new 52-week low. That's with the New York Composite Index 50-day rate of change above 0 and the McClellan Oscillator below 0. Does this add anything to the discussion? Probably not. I just wanted to show it here because I often get questions, and if I don't show it, someone will ask me about the Hindenburg omen. So I'm getting ahead of that question and showing you, yes, indeed, it did. I would, as I've mentioned before, I think the real signal was here. I think that's part of the early warning system. The Hindenburg omen usually happens, and it has to happen when the markets are still in an uptrend. Because if the markets are in a downtrend, that eliminates the vital measurement of the 50-day rate of change being positive. So if that's not positive, you can't actually have the Hindenburg omen conditions. One of the conditions is we're in an uptrend because it's meant to identify a potential top. So I think the November to December and really late December confirmation with multiple triggers within a month was that early warning system, along with and really ended up leading to further breadth divergences, further momentum divergences. And now we are where we're at now. I think the Hindenburg omen was an early warning of this particular environment that we're witnessing now this week. Stocks over bonds. I saw a question earlier about the bond markets, and is it surprising? I mean, yes and no. I would say, stocks and bonds that have been pretty positively correlated for a while. Over the last couple weeks, we've seen that change, where stocks are going higher, and bonds. Oh, sorry, stocks rotating lower and bonds rotating higher. We talked about the TLT breaking above trendline resistance. That is causing this ratio, which is basically the stock to bond ratio, SPY versus TLT, breaking down. Now, what's interesting is if you look back, this ratio has been above its 200-day moving average almost entirely. Going back to the COVID period, right? You have to go back to the COVID era when the ratio was clearly favoring bonds over stocks. I was kind of going through that period of great uncertainty. But then from 2021 into 22, and then all through the subsequent years, this ratio has been trending higher, and it's been above its 200-day moving average. So interesting that it's pulled back to the point, similar, pretty much the weakest that this ratio has looked. The last time it looked this weak was in July, August of last year, which is the most major drawdown of 2024. What happens if this breaks below the 200-day moving average? I think that's part of the, at this point, again, you're still sort of debating how far down do we go? How painful does this get? Ratios like this breaking down to a degree we've not seen in 5 years, for me, would be part of those things of, okay, this is something new and different and more painful. We've had a lot of examples of where this has been a brief pullback in the ratio. It's sort of a brief rotation before the uptrend continues and stocks work again. This ratio breaks below the 200-day. It starts to feel like a very different environment. Another thing we're seeing, just to get into some stock discussions here, is the ratio of high beta versus low volatility. I remember when I've interviewed Ari Wald of Oppenheimer, he's often quoted a version of this chart looking at the relative performance of these two ETFs. There are two Invesco ETFs that track a high beta index and a low volatility index. And just so you're familiar, if you're not familiar with these terms, these are terms used a lot in the institutional world. High beta basically means higher risk. So a beta of 1 means when the S&P moves 1%, you move 1%. A beta of 2 means you probably have about double the movements. And so if the S&P goes up 1%, you're probably going up about 2%. And it's taking averages and things like that. But it's a general way. It's a way to look at one number and get an idea of how much a stock tends to move relative to the benchmark. And 1 means you're kind of in line with the S&P. So high beta means it's higher risk, higher, more volatile names that tend to move more. Low volatility is kind of the opposite. These are names that tend to move a little bit less. So things like utilities, REITs, things that aren't as actively traded, things that are not super volatile. So if the S&P and the NASDAQ are moving 5%, these are probably moving a lot less than that. So when life is good and we're in a bull market phase, you generally want to own high beta stocks, because then you're going to have greater returns than the S&P, which is already going up. In a down market, or if you're concerned about the market going lower, you want to be in more low volatility things, because then if the market goes down 20%, you're probably going to go down less than 20%. So looking at this ratio helps you see what's working, the risky stuff or the not so risky stuff. Look at how this ratio has plunged in the month of February and really accelerated into the month of March. And I would say that's really going into mid-February. This is part of the way we've illustrated this phenomenon, has been the relative performance of defensive sectors, all which have rotated higher, right? So healthcare, consumer staples, utilities, real estate, those 4 sectors did incredibly well in the month of February, particularly the last half of February, as we finally saw that big rotation to defensive positioning. That's why this ratio is really plunging down, because of rotation to a more defensive side of the coin. The VIX is popping higher. The MOVE index, which I'm not showing here, also moving higher. That's sort of like the VIX for the bond markets. Volatility is increasing. Volatility can increase in bull markets, but it rarely does, because we rarely are interested in owning more stocks and then panic and buy a ton. Although FOMO is a thing, but it's not that much of a motivator. Fear of losing everything is a much greater motivator for people, and panic selling. We don't see a lot of panic buying, although you do, but not as often as panic selling, right? When you get nervous, you tend to panic and hit the sell button and unwind and try to just save everything you can. And so as a result, spikes in volatility usually means not great things for the market. The VIX did trade higher through the course of the day. At the end of the day, on a closing basis, finished around 2350. I was going to put this just on an intraday basis just to see. Yeah, so we got up to around 26 and change today, it looks like. So not end of the world kind of levels, but certainly not great. And so I would say the fact that the VIX has pushed above 20 over the last week is one of those, kind of guideposts that we've not observed yet that now we are observing. Volatility is increasing in a similar way to previous bear market, the beginning of bear market declines. I think that's a problem. All right, let's keep going here. So that was the VIX. We want to show the chart of Bitcoin just to show that it is obviously a very volatile chart. There have been times when the volatility of Bitcoin has actually come down a bit. This is not one of those times. It is a choppy, sloppy movement. Just in the last 72 hours, we've seen a bounce off the 200-day up to almost 95,000, a rotation back down to around 83,000, 82,000, and now back up to around 87, 88,000, which is where we're at right now. Just like the S&P, we talked about testing the 200-day moving average. Same exact thing for Bitcoin. And again, this is one of those basic things. As much as we can complicate things, as much as we can get cute with a lot of indicators, the basic assessment is this thing above or below the 200-day moving average is a great kind of simplistic measure of what's working and what's not. Bitcoin has been above its 200-day moving average since October of last year when it broke above there. That fueled the rally up to 108,000. It's most recent and really, all-time high. We retested that level in January in what is looking more and more like a big double topping pattern. And now we're breaking down and testing the 200-day moving average again. We break the 200-day. I'm looking at around 73, 74,000. That would be a 61.8% retracement of the way back to the 24 lows, the late 24 lows. That would also line up really well with the highs that we experienced for much of 2024. So with Bitcoin, similar to the S&P, we're kind of right at that point. We break the 200-day, and I think you have to initiate downside targets. All right, let's look at some individual stocks here to finish things off. NVIDIA sort of bouncing around support. But what I would tell you, the reason why I want to include this chart is I would say it's clearly a different environment, right? The environment back here in September and October of last year, uptrend of higher highs and higher lows. You can see the parallel channel of the lows and the highs. We then have a sideways or consolidation period where the highs are steady around 150 and the lows are steady around 130, 131, 132, we'll call it. Then all of a sudden we break down, we bounce off the 200-day, we fail to hold the 200-day. So while the S&P and Bitcoin are testing their 200-day, NVIDIA and other semiconductors have failed to hold theirs. We're now making lower lows and lower highs. I would argue that's now in a primary uptrend. The momentum is clearly in the bearish range after being clearly in the bullish range going into the fourth quarter of last year. We're now clearly in a bearish range where rallies stall out at an RSI level around 60. I think NVIDIA and other charts like it have now rotated. And while we're not down a ton from all-time highs, we are down quite a bit. And again, the primary downtrend is the challenge here. Bank of America, NVIDIA breaking below its 200-day. There are a number of stocks that are actually actively testing moving average support, just like the S&P is. Bank of America comes to mind as a stock that stalled out around 48, now rotating lower. The 200-day moving average now being tested, the swing low from December now being tested. And that's what I would say, like here, I think the pullback from 48 to 42, you could write that off as a pullback within a consolidation, and that the uptrend phase, the long-term uptrend, is still okay. We start breaking the 200-day and breaking below this range of the last 4 months. I don't think you can call that an okay chart anymore. I think that becomes a lower high, a weaker momentum reading, and now a breakdown of expected support. Delta Airlines, similar in that it's testing its 200-day, but look back here when we pulled back to sort of 58 at the beginning of the year. We had this beautiful hammer candle that led to a new high with Delta touching briefly $70 a share. Now we're rotating back down. We're currently testing the 50-day moving average just around $54 a share. That's breaking down through support. So again, when you have charts like this, when they're unable to hold that most recent swing low, that's a problem because now all of a sudden we're not making higher lows anymore. We're making lower lows. So again, this is a stock breaking down after divergences that we highlighted on the show. Zoom, why did I even put this in here? Oh yeah, I wanted to talk about this one pulling back. It's actually pulling back to a 200-day moving average. I'll do the daily chart instead. I had the weekly chart on there just to show this. That what's interesting about the weekly chart, I'll go there first. The weekly chart is cool because if you look at this resistance level, this is around $75, and you can see that was resistance through much of 2023. We then sold off. We then finally broke above that $73 level, and now we're kind of pulling back. So does resistance become support? When we're here right at the 40-week or the 200-day moving average, kind of right about here. The bad news for Zoom is we gapped lower on earnings last week, traded down to the 200-day moving average. That's after stalling out in an attempt to break above those previous highs. We're now making lower lows and arguably lower highs. The 200-day, though, is key. So we're testing support from before. We're testing the 200-day. You can see how I'm seeing more and more of these individual stocks testing those levels, which means they break below the 200-day moving average. The floor that you're kind of looking for, which I think would make this a buyable pullback within an uptrend, is no longer there. And then it just leads you to question what's next. And most likely further deterioration would be my assumption here. Ross Stores is another one. Again, I'm not thrilled with the chart from a technical perspective. I think we're in a downtrend phase here. Lower highs, lower lows. The momentum is pretty rough with the RSI consistently below 50. The relative strength has been trending lower. We are testing support here, though. We are trading just below those lows from November, which is pretty much in line with the lows from August. But you can see they're all kind of in a straight line here, kind of right at that point where we're at a key support level. I mean, we're well below the 200-day moving average already. So this is not the type of chart I would generally enjoy taking a shot at. But if you're more of a contrarian, I could get the argument of buying a test of support, limiting your downside risk using some sort of stop just in case you're wrong, but betting on some mean reversion. I wouldn't blame you for making that kind of a case for something like Ross Stores. For me, I'd much rather wait for it to show signs of accumulation. So what, if anything, is looking good here? I'll show you a couple ideas of things that are kind of looking interesting. Within healthcare, you have charts like this, right? Stryker is currently above 2 upward sloping moving averages. And back in 2024, when I was a broken record saying, and this is another stock above 2 upward sloping moving averages, and here's another one, because pretty much everything felt like it was, with some exceptions. But now the Strykers of the world are a lot more rare because most things that have been in uptrends have broken below their 50-day. And some of those that broke their 50-day are actually testing, if not having broken their 200-day, which makes charts like Stryker really, really interesting. This would be a really interesting time, by the way, to use the scanning engine on a platform like Stock Charts or some other platform that you use. Look for stocks that are currently above 2 upward sloping moving averages. It can be done. And I think you'll find charts like this that, if you didn't know that the market was going through the turmoil it was, the chart of Stryker wouldn't tell you that. And in a period where it feels like a lot of things are struggling, charts like this that look like they're immune to that are even more valuable than they would be in a normal cycle because it tells you something's different. Erie is an insurance company, and again, a representative of a number of charts, I would say, in that area, just breaking above the 200-day moving average. This is after sort of, going through a downtrend phase in Q4, finding some stability around $380 a share, and then just starting to rotate higher. When you have this kind of pattern where we're below the 50 and 200-day moving average, we just want to see that change, right? We want to see a rotation back above resistance. And in the last couple sessions, we have seen a push back above the 200-day moving average. I think within the financial sector, insurance has been kind of an interesting name. Would like to see if that can hold its 200-day moving average. Phase, I just want to highlight a bullish engulfing pattern because we don't have a lot of those right about now. It looked like the S&P was going to have maybe some sort of bullish candle structure, but it was not the case. But what we can see is renewable energy equipment stock and phase ENPH. While to be clear, in a downtrend below 2 downward sloping moving averages, personally, this is not the type of stock I like to buy because I'm not a falling knife kind of investor. I'm much more of a buy things once they've rotated. But if I was looking for beaten down names showing some initial signs of improvement, a candle pattern like we saw today is an interesting one. And if you're more of a swing trader, I'll share with you something that Steve Nissen shared with me years ago. Back in my Bloomberg days, I was working with Steve Nissen on some candlestick charting stuff, not surprisingly. And I remember him talking to him about 2-bar patterns like this, or 2 candle patterns. And his point was, remember that candles have a built-in stop. So if you have a 2 candle pattern like this, the idea is like going into the close, you can assume that is now a bullish 2 candle pattern, which means the next 1 to 3 bars are probably higher. You use the low of that 2-bar pattern as your natural stop. So you buy going into the close with that low as your stop. And as long as that holds, it tells you it's working. If it doesn't hold, then the bullish engulfing pattern didn't work and you move on to something else. But charts like this, when you have things that are going down, I love scanning for candle patterns, which stock charts and other platforms allow you to do, just to look for things that might have a contrary bounce. And even if it's not a big long-term rotation higher, hey, it's a change. Finishing with JP Morgan here. And I will tell you, if there's one thing that concerns me, and I'm sure what you're thinking is one thing, because I feel like I've outlined quite a few of them. But if there's one thing, I would say it's the change in financials. I think financials have been one of the better places to be in 2025. In fact, it's been the best performing S&P sector through yesterday's close. Because I remember quoting that for my our monthly chart review earlier today. But I will tell you, JP Morgan's breaking below its 50-day moving average. That's not the end of the world necessarily, but it definitely tells me that it's on watch, that it's on warning, right? We're starting to potentially change. JP Morgan does not feature the bearish momentum divergence I think we've seen in a lot of other names in the financial sector. But, again, I'm looking to see if that's an emerging theme of a breakdown in the financial sector. What happens if things like this continue to break down? That could mean a further rotation away from some of these value places that have done quite well, and maybe it's further into defensive areas of the market, which continue to do quite well on a relative basis. All right, I couldn't even keep up. It was a rapid fire quote. I'm thrilled that you guys are chatting, and I'm a fan. Let me take a look at what kind of questions I can grab among lots of comments here. And I appreciate you guys chatting. Let's see. Here, a shout out to Danielle Shea. Big fan of Danielle and her work. I need to get her on the Market Misbehavior podcast. So I'll see what I can do along those lines. She's actually based in the Pacific Northwest, where I'm usually at. So maybe we can meet up in person at some point. 3P Investor, thanks as always for watching, my friend. You asked, if 24 is not your end of the world VIX reading, what is? 30, 35. Also, will you say it has to remain high for a few days? Yeah, so the VIX is tough, and I will tell you, there's a reason why I've never created like a trading system based on the VIX doing a certain thing. And the reason is because, I think for me, volatility, I bucket, if you think about how I bucket different parts of the macro discipline, my main way of analyzing the markets is through price, right? Price is king, price is number one. So the price of the S&P, where it's at relative to where it's been, that's primary. The secondary part, second in importance, would be breadth when I'm talking about macro conditions. What about all the individual stocks? And I think that's one of the great benefits you get when you're analyzing a something like the S&P is there's 500 stocks or so that comprise the S&P, and we can gather some information based on the performance of those individual stocks. So breadth indicators, secondary, but still very important. Sentiment for me is the tertiary. It's the third one down. And I group the VIX, the put call ratios, survey data like the AAII survey. I put those all in a third bucket called sentiment. They are not as important as the S&P and other stocks in terms of price. They're not as important as breadth in my work. However, I think they're important. The problem I have with sentiment data, any of those things that I mentioned, is that I've not found they're great timing tools, right? The VIX pushing above 20 to me is not like a sell signal, like, the VIX hit 20, we need to take 50% off. So I don't have a market trend model based on the VIX. It's based on the price of the S&P because that's what's most important. So having said that, I think the VIX above 20 gives you descriptive information about the mindset of investors, the panic nature of the movements that we're seeing in price. The additional volatility does not usually come in a bullish environment. It comes more when people are getting nervous and they're probably selling. And so spikes involved for me are descriptive. They're not, I don't know if prescriptive is the right word for that. So I'll stop talking. So, levels that I watch, 20 is the one level, 29, 28, 50, 29 is the second level. This is annotated on my chart with the horizontal blue level and the horizontal line in green. The blue level comes from my own work. For years, I just waited for the VIX to push above 20. In a bull market, it would tend to be below there. When it would pop above there, that would tell me something's different. A VIX above 2850, that comes from a conversation years ago with Tim Hayes, who's the chief strategist at Ned Davis Research. Ned Davis did a bunch of great research on VIX levels, and they found in their work, as long as the VIX remains below 2850 or 2860, I forget the precise level, then things are probably okay. But if we would start to get above there, that's when the average forward-looking returns become a lot less awesome. And so I think that is the that is sort of the level to watch. The reason why I'm not that hard and fast on particular levels is because if you take this chart of the VIX and bring in more data, you will see that actually the VIX is not as stable as you think, right? So there are times when 20 is a very high level, and there's times when 20 is a very low level. And I would say the VIX tends to move in what we call volatility regimes. There will be a high volatility period where the entire range of the VIX kind of moves up. You can see 2022 is an example of that, right? Where 20 was actually one of the lower readings you got through the entire year, and we would routinely get up into the 30s. Compare that to like 23 to 24, where for that 12-month period, we rarely touched 20. And if we did, that was a very high rating for the VIX. So what I'm seeing is that the volatility regime has changed from the first half of 24 to now the back half of 24 into 25, and it's more like a 2022 kind of volatility and less like a 23 kind of volatility. But that's why I don't focus on particular levels. It's more regimes. I think the entire volatility sort of range is bumping higher, and again pushing above 28. 29, 30 for me tells me we're probably in that kind of environment, like a 22 kind of period, because that's the only time when the VIX really gets elevated to those kind of levels. But that's why I don't have specific other levels that I would suggest. Charles, thanks so much for watching on YouTube. I'm guessing the Trump address is going to affect the markets a lot tomorrow. Could be a wild day. I mean, do we need any more wild inputs or news flow? And I've had a lot of questions along those lines about what to do with all the news and all the headlines and just the unpredictability, the nature of this. I mean, for sure. I mean, I think the news flow out of Washington, the degree to how quickly policies are being changed is certainly increased. So, I mean, the VIX on policy changes is pretty elevated at the moment, I would say. And so for me, what that tells me, and again, that does not tell me for a moment to ignore charts, because charts are the only way we can actually understand expectations going into something happening, right? So if there's some crazy, like let's say tariffs are all taken away tomorrow. I don't know if that is something, maybe that happens, right? Who knows? But if it does, we know the sentiment going into that is really negative. So like that is the mindset that investors have. They're kind of panicked. They're getting nervous. They're getting very defensive. And as a result, I think that tells you something about the mindset. Going after it. Let's say tariffs are taken off and all of a sudden we completely redesign yet again our relationship with our partners to the north and the south here in the US. What that would change things for sure. And so I think looking at charts to see how investors react after that. What does that mean for assumptions about inflation and interest rates? All of that is best interpreted through charts. So while we can't predict a news event happening at a particular moment or what it means, we can use charts to gauge sentiment, investor psychology, and supply and demand going into those announcements, during those announcements, and coming out. So I think this is a time to watch charts more than ever, if there's ever a time to do it. Listen, folks, awesome questions. I scratched the surface of the questions we got because there's so many of them. We do need to wrap for time here, but I am going to put a number of those into the Chart This mailbag. Please tune in on Friday's episode, and we'll go through some of those in a lot more detail. As a reminder, the podcast is going strong. Recent episodes with Lindsay Bell of Clearnomics, with Jay Woods of Freedom Capital Markets, really fascinating conversations, really dealing with these rotational elements that we've been observing here. I have a couple more episodes to get out to you from the Money Show recently, and I'll get them out as soon as I can. In the meantime, have a fantastic night. And remember, it's always a good time to own good charts. Thanks for tuning in, folks.